Welcome to our latest deep dive. Today, we're breaking down an analysis of a company you definitely know, the J.M. Smucker Company. You see their products literally everywhere, right? Jif, Folgers, the list goes on. But does that automatically make Smuckers a good investment? Well, the analysis we're covering today suggests it's a bit complicated. So you've kind of got this split personality. On one hand, you have these powerful, iconic brands with super steady demand. But on the other hand, oh boy, the financials are flashing some serious warning signs. Okay, let's dive into this. Here's how we're going to break this all down. We'll start with the big picture, check out its competitive strength, really dig into the numbers, figure out what it's worth, and then find the right price before we get to the final verdict. First up, a company at a crossroads. So what is Smucker's business, and why is it in such a tricky spot? The business model is pretty straightforward, right? They sell tons and tons of stuff people buy all the time. Coffee, pet food, you know the drill. It's a high-volume, low-margin game. The core issue now is that its profitability has become increasingly cyclical because the cost of its ingredients are just all over the place. Okay, so let's move on to its competitive advantage, or what investors call its moat. How strong is it, really? So Smucker's entire moat is pretty much based on its brand names. And yeah, those are strong, but that advantage is definitely getting weaker. You've got giants like Nestle and General Mills with way more scale. And let's be honest, private label brands are getting really good. Plus, what does it cost you to switch from Jif to a store brand? Nothing. That moat, well, it appears to be shrinking. All right, now for the hard numbers. This is where we really get to see what's going on under the hood. So there's a little bit of good news. Revenue grew 7% year over year. And hey, free cash flow is positive at almost $900 million. But, and this is a big but, the bad news is pretty staggering. Net income is actually negative, and the balance sheet is looking weak. And check this out, a negative 20% return on equity. That is a huge red flag. It basically means the company is not using shareholder money to make a profit efficiently at all. And then there's this number, $7.5 billion in total debt. You know, for a company in this kind of industry, that is a really big pile of debt to be sitting on. And this, a current ratio of 0.84. So anything under 1 means you have more short-term bills than you have short-term cash and assets to pay them. That can signal a potential liquidity crunch down the road. Okay, so with all those financial issues on the table, what's the business actually worth? Let's talk valuation. This analysis calculates a couple of key values. Based on future cash flows, the intrinsic value comes out to about $72. Based on its normalized earnings power, it's about $85. Now, compare that to what the market was paying, nearly $94. You see the gap there, right? The SWOT analysis here really puts a number on it. The final score is a 4.45, and you can see why. It's getting pulled down by some major weaknesses, like that debt we talked about, and serious threats from competition. So what could happen in the future? Well, in the base case, we're looking at that $72 valuation. If things go south, the bear case puts it at $55. But here's the kicker. Even in the best case, bull scenario, the value is just $95, which barely clears the current stock price. Not a lot of upside there. This brings us to the most important question for an investor, right? What's the right price to pay? So let's try to figure out what a good entry point would be. And just as a reminder, this analysis was done when the stock was trading around $94. Okay, so if you're aiming for a 9% return, your buy price really depends on how long you plan to hold on. For a 5-year hold, you'd need to get in around $85. But look, if you're in it for the long haul, say 16 years, that buy price drops all the way down to $70. And this just illustrates that trade-off perfectly. If you're okay with a lower return, say 5%, you could maybe buy it around $90. But if you want a 10% return, you'd have to be patient and wait for the price to fall to $65. All right, let's pull all of this together. What's the final verdict? When you look at risk versus opportunity, the scores are really close. The risk score is 5.8, and the opportunity is just 5.2. That's not really what you want to see. It suggests that right now the risk just might not be worth the reward. So here's the key takeaway from this whole analysis. At its current price, Smucker's is a hold with caution. A buy signal where you have a real margin of safety doesn't even start to appear until the price drops below $70. You know, this analysis really shows how a company that feels so stable and safe can have some serious risks hiding just below the surface. So what companies should we break down next? Let us know in the comments. Thanks for watching.